It's experience, and we think to combine everything together, we are looking forward to a fantastic future of Bugatti.
Let's be realistic. Making hypercars is not going to change the world.
For 28 years, one company built Bugatti into the most extreme hypercar brand on the planet. The Veyron, the Chiron, and now the Tourbillon. Then, in April of 2026, that same company signed away its ownership stake and walked.
VW gave Bugatti the freedom to build the impossible, but the VW era of Bugatti has now ended.
The timing could not be stranger. Bugatti had just closed its most successful production year in history, with a brand new hybrid hypercar already rolling toward customers. Yet at the exact moment everything seemed to be working, Volkswagen's Porsche division chose to exit completely, handing control to an entrepreneur and outside investors nobody saw coming. This video breaks down the numbers behind that exit, the timing nobody can explain, and who inherits Bugatti now. How Bugatti became a benchmark. To understand what just ended, the story has to start with what was built. Volkswagen acquired the Bugatti name in the late 1990s, inheriting a legendary badge that had been dormant for decades, and turning it into something the automotive world had never seen before. The result was the Veyron, a car that, when it launched, redefined an entire category. Before the Veyron, hypercars were a loose idea. After it, they were a measurable standard, and every manufacturer chasing extreme performance had a new number to chase. What followed was nearly 2 decades of escalation. The Veyron gave way to the Chiron, which pushed the same formula further. More power, more speed.
The Veyron and the Chiron are incredibly fast. But Bugatti isn't just about speed, it's about excess engineered properly.
Piece of mechanical folklore as it was a powertrain. Limited editions followed one after another, each one a 6-figure or 7-figure statement piece for collectors who measured exclusivity in single digits of production. Under Volkswagen's ownership, Bugatti was never expected to turn a conventional profit in the way a mainstream car brand would. It existed, in large part, as a flagship, proof of engineering capability that justified the prestige attached to the wider Volkswagen group. Then came 2021, and the first real structural shift. Porsche and the Croatian electric performance company Rimac Group formed a new joint venture called Bugatti. Rimac, designed to merge old-world hypercar heritage with new-world electric expertise. Porsche held 45% of the new structure. Rimac Group held the remaining 55%.
Porsche will divest its 45% stake in Bugatti Rimac.
On paper, it looked like a forward-looking move, pairing a brand built on 12-cylinder and 16-cylinder excess with a company whose entire identity was built on electric powertrains. Was this the moment Bugatti quietly began preparing for a future its own engine lineup could not survive? By 2025, the partnership had produced its most visible result yet, the Tourbillon, Bugatti's first hybrid hypercar, combining an 8.3-liter naturally aspirated 16-cylinder engine with 3 electric motors for a combined output of roughly 1,800 horsepower. Bugatti itself described the car as a complete reinvention of everything the brand had produced over the previous 20 years. Production was capped at 250 units. It was, by every measure, the clearest signal yet that Bugatti intended to survive the transition away from pure combustion without abandoning the theater that made it famous in the first place. Nobody inside the company was talking about walking away. Everybody was talking about what came next. It helps to remember how unlikely this entire empire was in the first place. The Bugatti name traces back to a French manufacturer founded in the early 1900s by an Italian-born engineer, a company that produced some of the most celebrated racing cars of its era.
This is one of the biggest and most important assemblages of Bugatti items ever under one roof. And it's not just cars, the cars that Ettore built.
Before collapsing into decades of dormancy after the Second World War. When Volkswagen revived the badge in the late 1990s, there was no guarantee the gamble would work. Reviving a century-old name with no factory, no workforce, and no modern product line was, by most conventional business logic, a reckless use of capital. It worked anyway, spectacularly, because Volkswagen treated Bugatti less like a profit center and more like a technology showcase, a rolling demonstration of what its engineers could achieve when cost was treated as a secondary concern. Every halo brand in the Volkswagen Group portfolio benefited from the association, even divisions that never built anything resembling a hypercar themselves. Is it possible to put a price on that kind of prestige? Or does removing it always cost more than the balance sheet admits? That halo effect is part of why Bugatti's ownership history matters so much now. A brand built explicitly to lose money in service of prestige operates under a completely different set of rules than one expected to justify its existence through quarterly earnings. The moment a parent company starts asking that question seriously, what is this actually returning on? Investment. The entire foundation the brand was built on starts to wobble, regardless of how many records the cars themselves continue to break on a track. The numbers behind the exit. The official story behind Porsche's exit is, on its face, straightforward. According to Porsche's own statement, the transaction agreements were signed on April 24, 2026, selling its 45% stake in Bugatti Rimac and its more than 20% holding in the broader Rimac Group to a consortium led by the New York investment firm HOF Capital, with Blue 5 Capital joining as the largest single investor alongside additional backers from across the United States and Europe,
as well as a 20.6% stake in Rimac Group to a consortium led by US-based HOF Capital.
Completion still depends on standard regulatory clearances, which Porsche has indicated could extend into the latter half of the year. Stripped of all the engineering history, this is, at its core, a sale of equity. So why does it feel like so much more than that? The financial backdrop explains a significant part of the urgency. Reporting from Reuters has tied the timing of the sale directly to Porsche's deteriorating profitability, with margins falling sharply through 2025 as the company absorbed weaker demand across China, slower than expected momentum in its electric vehicle lineup, and the broader cost of restructuring its global operations. Some reports place the scale of that profit decline at a level rarely seen at a company of Porsche's size, a near-total collapse in earnings within a single fiscal stretch. When a parent company is bleeding that badly, even its most prestigious holdings start to look like luxuries it can no longer justify keeping on the books. China's role in this story deserves particular attention, because it is rarely just background noise in conversations like this one. Porsche, like much of the legacy European luxury auto industry, built years of growth on Chinese demand that has since slowed considerably, squeezed by local competition and a broader economic cooldown. At the same time, the company's own push into electric vehicles has not generated the returns executives once projected, leaving Porsche holding development costs without the matching sales volume to offset them. Layer a struggling joint venture with an outside electric specialist on top of that, and the math starts to explain itself without needing any deeper conspiracy. Is this simply a company protecting its core business by shedding everything that is not essential to it? There is also a structural reality worth acknowledging. Joint ventures built between two very different corporate cultures. A century-old German luxury manufacturer and a fast-moving electric vehicle startup, founded only in the past decade, do not always integrate as smoothly as the press release promised at launch. Differences in decision-making speed, risk tolerance, and long-term vision can quietly erode a partnership long before any public statement acknowledges friction. None of that has been confirmed publicly in this case, but it is the kind of explanation that often sits underneath a clean financial narrative. waiting for more details to surface once the deal itself closes. It also helps to place this exit inside the wider context of what the Volkswagen Group has been managing over the past several years. The broader automotive industry has spent this stretch absorbing one of the most expensive transitions in its history, pouring enormous capital into electric vehicle development, while combustion sales, in many markets, remained more resilient than forecasts predicted. That mismatch has squeezed margins across nearly every major manufacturer, not just Porsche. Several legacy brands within larger automotive groups have faced similar scrutiny over the past 2 years, with parent companies reassessing which subsidiaries justify continued investment and which ones get spun off, sold, or quietly wound down. Bugatti's situation does not exist in isolation. It fits a pattern playing out across the industry, where even celebrated, high-prestige assets are no longer automatically protected from cost discipline. There is a reasonable case that Bugatti, specifically, was always going to be vulnerable to exactly this kind of review. A brand built around producing a few hundred extraordinarily expensive cars a year does not generate revenue at a scale that moves a company the size of Volkswagen in any meaningful way. Its value was always reputational rather than financial. Reputational value is the first thing executives reconsider once a balance sheet stops giving them room to fund things that do not show up clearly in quarterly results. The gap between reality and the exit numbers alone rarely tell the full story. And this is exactly the kind of case where timing forces a second look. Bugatti's own newsroom celebrated 2025 as an extraordinary year, its highest production total in the brand's entire history, alongside what the company itself described as a wide range of forward-looking achievements, laying the foundation for 2026 and beyond. That is not the language of a brand in decline. That is the language of a company at its commercial peak, by its own internal measure. So why would the parent company holding nearly half of it choose this exact moment to walk away? Compare that against the broader product roadmap. The Tourbillon was still in its rollout phase, with deliveries to customers only beginning in earnest. The brand's ultra-exclusive Solitaire program, limited to 2 bespoke one-off hypercars a year, had just unveiled a tribute build honoring the original Veyron on the 20th anniversary of that car's debut, with each commission reportedly commanding price tags exceeding $20 million. The legendary quad-turbo 16-cylinder engine that defined Bugatti for 2 decades was also taking its final bow.
Bugatti came known for that W16 engine, but it was also heavy and complex, inefficient and impossible to evolve forever.
With limited send-off models like the Mistral and Brouillard, closing out that chapter on the brand's own terms, rather than being abruptly discontinued. Every visible signal pointed toward a brand managing its own transition deliberately and successfully. None of it pointed toward instability severe enough to justify an emergency exit. That contrast is precisely what makes the financial explanation feel incomplete on its own. A parent company does not typically abandon its most prestigious, best-performing asset purely because the asset itself is struggling. Not when every public metric says the opposite. What it does sometimes do is abandon an asset when the parent company's own internal priorities have shifted so dramatically that even a thriving subsidiary no longer fits the plan. Porsche is not just trimming Bugatti. According to the same reporting that revealed the sale, Porsche is simultaneously stepping back from its broader stake in Rimac Group itself. The electric technology partner Bugatti was supposed to be building its future alongside. Is that a coincidence? Or is it evidence of a parent company retreating from electrification bets across the board, not just the ones tied to a single hypercar brand? There is a version of this story where Porsche's exit is purely defensive. A company under financial pressure cutting anything that is not core to its identity. regardless of how well that asset happens to be performing in isolation. There is another version where the exit reflects a deeper retreat from the electric ambitions Porsche itself helped fund just 5 years earlier. Both versions can be true at the same time. Financial pressure rarely arrives without also forcing a company to reconsider which long-term bets still make sense, and which ones it can no longer afford to wait out. Because Bugatti is not the only storied performance brand facing this exact crossroads right now. Across the wider luxury and performance automotive world, manufacturers are being forced to choose between doubling down on electrification or retreating toward the combustion theater that built their original fan bases. Some brands have leaned fully into electric powertrains as their next chapter. Others have slowed their electric timelines considerably, citing softer-than-expected consumer demand for high-performance electric vehicles compared to traditional combustion or hybrid options. Bugatti's Tourbillon sits deliberately in the middle of that divide, hybrid rather than fully electric, preserving the combustion theater while gesturing toward an electrified future. Did Porsche's exit happen because that middle ground strategy stopped looking viable to the people funding it, even while customers themselves seemed satisfied with the result? That question becomes sharper when placed next to one more detail buried inside the broader reporting on this deal. The same consortium taking over Bugatti Rimac is also positioned to support Rimac Group's continued expansion independently, suggesting the new ownership group sees value in keeping the electric technology side of the business moving forward on its own terms, separate from whatever direction Bugatti's combustion-rooted product line ultimately takes. That separation, if it plays out as structured, would mark a quiet but significant divergence from the original 2021 vision of merging the two companies into a single unified future. The new stewards of Bugatti, with Porsche stepping aside. Full control of Bugatti Rimac moves to mate Rimac, and the newly assembled investor consortium, led by HOF Capital and Blue 5 Capital. For Rimac, this is not simply an inheritance. It is the culmination of a 5-year arc that began when his much smaller electric vehicle company was paired with one of the most storied names in automotive history. What started as a 55% majority stake in a joint venture now becomes outright stewardship of the entire Bugatti brand, backed by fresh institutional capital rather than a legacy German conglomerate's balance sheet. What changes under this new structure is still taking shape. Bugatti retains its existing leadership, its design language, and its Molsheim production base in France. None of that is reported to be shifting in the immediate term. What does shift is the source of long-term capital and strategic direction. A consortium of investment firms operates under different incentives than a publicly traded conglomerate, typically expecting a return within a defined horizon. Does new ownership mean more aggressive expansion of the hypercar lineup, or a tighter, more conservative approach designed to protect value rather than chase further engineering spectacle? There is also a symbolic dimension hard to ignore. Volkswagen's exit closes out a chapter that began nearly 3 decades ago, when a struggling, dormant badge was rescued and rebuilt into the most extreme car brand in the world. Handing the keys to an electric vehicle entrepreneur who was still in primary school when the modern Bugatti era began is its own kind of statement about where the industry believes performance engineering is heading next. Does that handoff represent a passing of the torch, or the slow absorption of a combustion-era icon into an electric-era portfolio that may eventually reshape it beyond recognition? For now, the most concrete certainty is the calendar. The deal is expected to close before the end of 2026, assuming regulatory clearances proceed without complication. Until then, Bugatti continues operating largely as it has, building tourbillons, finishing out its W16 farewell models, and preparing its next solitaire commission. Mate Rimac's own trajectory makes this inheritance feel less improbable than it first appears. He built his company from a small electric conversion garage project into a manufacturer capable of producing one of the fastest production cars ever tested, eventually catching the attention of an industry that once dismissed electric performance as a gimmick. Being handed effective control of Bugatti is, in many ways, validation of that arc. Proof a skill set built around electric drivetrains and software-driven performance has become valuable enough to inherit a combustion-era icon outright, rather than simply supplying it components from the outside. The investor consortium backing that inheritance matters just as much as the man at the center of it. HOF Capital and Blue 5 Capital, along with the other institutional backers joining the deal, represent a different category of ownership entirely from either Volkswagen or Porsche, and typically build in a defined exit horizon of their own. Is Bugatti settling into stable, long-term ownership for the first time since Volkswagen's revival of the brand, or simply trading one set of temporary stewards for another, with a different exit clause waiting somewhere down the road? There is precedent both ways in the ultra-luxury automotive world. Several storied performance brands have passed through private investment hands before eventually finding stable ownership again, often emerging leaner and more focused. Others have struggled, caught between investors seeking a quicker return and the patient, decades-long brand building a name like Bugatti has always required. Which outcome awaits Bugatti depends on decisions the new ownership group has not yet made public, about production volume, pricing, and how aggressively to push electrified ambitions against its combustion legacy. Two explanations, one turning point. So which explanation actually holds up? A straightforward financial retreat, or something closer to a strategic abandonment of Bugatti's electric ambitions, dressed up in the language of a balance sheet? The honest answer is that both threads are documented, and neither one cancels out the other. Porsche's profitability genuinely collapsed. China's demand is genuinely weakened. The broader Volkswagen Group genuinely needs to protect its core lineup during a difficult stretch for the entire auto industry. None of that is in dispute. But the timing still matters. And timing is exactly what gets lost when a story gets reduced to a single headline. A company does not typically choose to exit its most prestigious, best-performing, most historically significant asset during that asset's best year ever, unless the decision was never really about that asset's performance at all. Porsche was not just selling a stake in a hypercar brand. It was simultaneously stepping back from the broader electric technology partner that brand had been built around for the past 5 years. That detail reframes the entire story, shifting it from Bugatti struggled to Porsche reconsidered its electric future across the board. And Bugatti happened to be standing inside that bet. What happens next will likely answer the question more definitively than any statement released today. If Mate Rimac and the new investor consortium accelerate Bugatti's transition further into electrification, that supports the theory that this was always a strategic divergence, dressed up as a financial necessity. If Bugatti instead leans harder into the combustion theater that built its legend in the first place, chasing more solitaire commissions, more send-off engines, more six-figure exclusivity, that suggests Porsche's exit really was about the parent company's own balance sheet, and nothing more. There is a broader pattern worth holding on to here, one that extends well past a single ownership transaction. Every era of automotive history eventually reaches a point where the company best positioned to define performance is not the one with the longest legacy, but the one most willing to absorb risk that legacy brands can no longer justify to their shareholders. Volkswagen took that risk in the late 1990s, when reviving Bugatti made little obvious financial sense, and paid off anyway through 2 decades of engineering prestige. Mate Rimac and his backers are now making the same kind of bet from the opposite direction. betting that electric and hybrid performance technology, not nostalgia for a 16-cylinder engine, is what carries Bugatti's name into its next chapter. Whether that bet pays off the way Volkswagen's did remains, by definition, unknowable until it actually happens. History does offer one consistent lesson worth carrying forward, though. Every previous owner of this brand believed they understood exactly what Bugatti needed to become. Most of them were at least partially right, and all of them were eventually replaced by someone with a different vision anyway. What remains certain, regardless of which explanation ultimately proves correct, is that this moment marks the end of an era nobody expected to end this soon. 28 years of one company's stewardship are giving way to something entirely new, built not on a century of German engineering tradition, but on an electric vehicle entrepreneur's bet that the next chapter of hypercar history belongs to whoever is willing to write it. That is the empire changing hands. 28 years of Volkswagen's stewardship, a Porsche exit timed to its own collapsing profits, and a Tourbillon-era Bugatti now resting in Mate Rimac's hands alongside investors nobody saw coming. Whether this was a financial retreat or a deeper walk away from electrification, the next 12 months will likely settle it. If this breakdown helped make sense of the deal, tap like before moving on. Down in the comments, was Porsche's exit purely financial, or was something bigger happening underneath it? Subscribe and turn on notifications, because the next video covers exactly what Bugatti's new owners do first.